Okay. Fintech marketing is a sum of marketing techniques specifically tailored for financial technology companies. These companies are using new technologies to improve and ultimately automate the delivery and use of financial services to customers. Whereas building a great product is the first step towards revolutionizing this industry, deploying the right fintech marketing techniques to make it big is often a challenge in an increasingly saturated market, especially when traditional banking companies are finally catching up with emerging technologies. Best in class user experiences and consumers' needs and expectations. At the same time, let's face it, financial services are boring from a consumer's point of view. That's no secret, and if we have no intention of covering that up, and neither do most of the companies that attempt to market their services. That said, what if I told you that there are 9 tricks you can deploy today to really position your fintech marketing efforts for success? First point is go mobile with your fintech marketing initiatives. Everything is mobile in the 21st century, and if you are not basing your marketing initiatives around these precious handled devices, you are missing out one of the most effective ways to collect with consumers. Recent studies have shown that we are spending 5 hours a day on mobile devices, and the time spent on mobile apps has skyrocketed a huge 69% from 2016. That's 5 hours a day where fintech companies can target mobile users to get the very most out of your marketing strategies. First, ensure that you have a mobile response website. In doing so, you'll not only rank better and higher in Google search results, but are more likely to create conversations from the visitors you will receive. And with 52% of all online searching being done on mobile, you really can't mess around with a suboptimal digital experience. If you cite as a collection of unnecessary widgets, pop-ups, or irrelevant content that makes navigation frustrating, chances are that the user is going to be and out of your site in a matter of seconds. So make sure your copy is short and to the point. Use visual elements like infographics, icons, imaginary, use large fonts on the responsive side, and non interactive animations. Multiply really spend the time to make sure your website looks and behaves amazingly on mobile before you waste money on traffic SEO efforts on making things simple, clear, and with a feathered call to action is a great way to get started on mobile to make the most of the platform available, but it does not stop there. Second point, make social your best friend. Social is the marmot of the internet. Some of us absolutely love the concept and are sharing pictures of our morning avocado toast 5 times a week, while others refuse to download or sign up to even the most basis of social sites. When it comes to fintech marketing, you are going to first need to identify the market sector you are going for. This directly impacts your use of social media and indicates where the most time and energy should be spent. Whether it's LinkedIn, Instagram, Facebook, Twitter, Snapchat, Pinterest, Reddit, TikTok, or YouTube, you are going to need to pick and choose which is the best to share your message and adopt a strategy for each. Really narrowing down and specifying who you are going to be targeting with the business as a whole, and then creating sub targets within different social media outlets in virtual. Snap is different to Telegram, Reddit different to Facebook. It's your job to learn the difference and know what works well. Social media is not one size fits all, but it does have one amazing advantage. over traditional marketing channels. Third point, create valuable content. Valuable content is exactly what it says on the tin. It's valuable whether you are creating a sticker that helps to clear up a topic in the reader mind or a how to guide on poaching an egg. If it's valuable content, it's golden. After all, you reach at because it's valuable, engaging, and you found us on Google. Content is more valuable than ever, especially in the fintech marketing space. A recent study found that 45% of millennials want financial products and services that help them handle their financial situation, but 37% said they could not find resources online to educate them on the financial topics. That's not only a shocking static, but a great area to step in and out be the hero of the day with your fintech content marketing effects. Fifth, fourth point, go bold with branding. If you are looking to make a bit of a splash with your fintech marketing, branding is a place to begin. The first thing that people will interact with is your branding. So you are get make sure it's killer. You can have the best content available, a fantastic social strategy, and a great mobile based platform. But if your branding looks like it was created right about when the dinosaurs were roaming the earth, something is not going to sit right. That's the point. Engage, engage, engage. Engage with your target audience for your marketing companions can be one of the most important factors in your long term strategy. Whether it's the comment section of Instagram or Facebook post, a real reply to an email or tweet, or a conversation on LinkedIn, engagement should be the number one priority for promoting the brand within the social. 6 point over deliver when you can, something that we will tell our customers from time to time. If you over deliver to your customers, promote that story again and again. Just think Southwest, the company has a long history of getting free PR thoughts ads of kindness. From that story, when a mom thanks Southwest flight attendants for client baby, when the company helped a baby to get back to the son when he had accident and went into coma. The world loves to hear the how Southwest goes out its way to help its customers. There's nothing more powerful than amazing customer service, and the over delivering of products and services is one of the best of the techniques. Do good and you'll do well. And seventh point is be smart with ad companions. You will never had more choice when it comes to ad companions for fintech marketing than right now. The problem that we'll see in many financial companies is that they are not marketing in the year that they live in. Fintech marketing should be about making an impact where the majority of the attention is for the target audience. But so many companies still use television advertisements and radio commercials when they should be using Google, YouTube, and Facebook. That's it from my side.
Okay, I will
Let
continue. In all the different list of the most lucrative and profitable sector of investment, the one name that would be common in fintech, going by the simple formula of monetary translation, something that customers would need to, irrespective of what the economical donation in the sector of made itself recession proof and turn investment friendly in continues to become investable to part of the economy with the involvement next generation of the technologies offering the set of the customers experience offers acting the benefit of the fintech in the critical we are the going look into the state of the investment fintech domain and with the important of the sectors in the investment the state investment rise the fintech domain the market size of the fintech sector going to be the 26.5 million in 2022 for a sector was the less hard of decade ago today become one of the most lucrative industries from the both investors and enterprises while adoption of the fintech fiat currency becoming digital. If you look back at you spending that changed the last decade, you will notice the shift how you conduct the transaction, how the majority transaction have becoming cashless. Through the made digital payments in the fintech, whatever we use the pay past, paying the coffee by using online banking, sending money friends to family, cash startup becoming thing the past. Data has become a new oil. Fintech brands tend to gather huge amount of the data related to consumer spending, the habits. When used to strategically, the data be applied to filling the different loops. Your mobile is your wallet. The time when you have had a carry a physical wallet, strongly money is long gone. You can now save your card and bank details in your phone, make a payment for a good and service. Almost every retail house and service based agencies. The social impact. Companies hold the power of serve millions people around the globe. Even the location which unbanked, they offer services which change the way of business are conducted by bring transaction on fiat mode. They can have the ability to eliminate the black money circulation. Fintech industry accuracy tend have deep pockets. A prime characteristic in the fintech domain that fintech companies competitors tend have been bucket. The competitors have the families liquid. The available rapidly accessible capital in the fintech domain such companies. According to PwC report, insurance companies are the aware fintech era. There are the enough re- reasons to believe that insurance sector heading path of digital innovation. Digital share broker. In increased volatility, share prices have brought a number of new investors in the market. Digital operating platform. There is a continuous need to operation platform which would be help to bring down the cost on better efficiency wealth management banking system. So that's it from my side.
Let me continue. So products is one of the important things we must need to focus. From opening accounts to insurance underwriting and credit profiling, fintech startups are piggybacking on the various services of traditional banks and flipping the conventional business models in a financial industry. With heaps of venture capitalist money flowing into the fintech ecosystem, challenger banks are threatening to wipe out banking faster than BlackBerry was taken out of the cellular telephone market. Let's now look at 10 different types of models through which we can deliver our products. The first one is alternative credit scoring. Many self-employed people with a steady source of income do not pass conventional bank loan screenings due to strict and outdated credit score criteria. Credit rating fintech companies such as Nova Credit are taking a new approach by considering alternative data points like social signals and percentile scoring amongst similar borrower groups. All these qualitative factors combined with an intelligent and self-learning algorithm can lead to better lending decisions over time. For example, if there is a way to determine negative profiles based on social presence before loan disbursement, then a lender can avoid having to deal with loan recovery. The second one here is alternative insurance underwriting. In today's world, two individuals with the same weight and height, both non smokers and who don't drink alcohol, will be given the same life insurance premium. However, one person might be an exercise freak while the other might be of couch potato and more likely to die of diabetes. These faulty premium calculations happen because of averaging out, called normalizing in actual terms, as risk premiums currently don't account for factors that aren't quantifiable. As with alternative credit scoring, fintech companies such as CapData are building variable premium computing mechanisms with alternative data points such as social signals, lifestyle, and medical history. Combined with intelligent and self-learning algorithms, these insurance tech companies can determine whether or not to give insurance provided different terms and conditions, and offer alternative payment options, for example, copay options. The third one here is transaction delivery. Data is the new oil, and managing it better can give immense insights into the needs and wants of the customer. Fintech startups in the transaction delivery space are creating free products such as expense management apps in order to collect customer data and then cross pollinate the data with the rest of the group to map the potential of the customer to pay premiums, invest in a real estate, buy mutual funds, etc. The business model involved in these types of fintech companies is commission based, for example, on reselling third party financial products. The fourth one is peer-to-peer lending. Peer-to-peer lending is when an individual borrows money from other individuals. Similarly, peer-to-peer business, P2B, lending is when a business borrows money from one or multiple individuals. These lending models are making it easier for investors to get better returns than those offered in debt markets by giving their money to pre-approved and vetted borrowers. Fintech companies such as Funding Circle create platforms to match borrowers with lenders and usually take a fee from the borrower's repayment. The fifth one here is small ticket loans. Banks and other lenders typically don't want to underwrite smaller ticket loans because of the low margins and high costs involved in setting up and recovering them. Fintech companies in the slice of the market are delivering impulse buy mechanisms, buy now and pay later, or BNPL, and one click buy buttons on e-commerce websites to enable customers to buy quickly without having to enter any form of authentication or credit card details. These loans will typically be underwritten at 0% interest, so that almost anything can be purchased outright with the option to pay in installments. How is their money made? By sharing customer data with the original equipment manufacturer, as they will benefit the most from the increased affordability of these devices. Combining this with algorithms that will determine customer demographics ensures highly customized marketing offers. Think of sharing our data with them as the interest on the loan. Sixth one here is payment gateways. Payment gateways are platforms that enable shoppers to pay for a product or service on the merchant's website. Today, there are countless payment methods such as debit cards, credit cards, digital wallets, and cryptocurrencies. Typically, banks charge enormous fees to handle transactions from all these different methods, but fintech companies are integrating all of these payment methods into convenient apps that online merchants can easily afford and integrate on their website. Typical users of these payment apps would be businesses selling either their physical products or services to end users. Example, GPay, PhonePay, etc. Now, the seventh one here is digital wallets. Digital wallets can be seen as a combination between a non-frills bank account and a payment gateway. With this business model, a user can preload a certain amount of virtual money into their wallets and use this virtual money to make either online or offline transactions with merchants who accept digital wallets as a payment mechanism. A digital wallet model typically involves giving user the convenience of making payments for a small fee that is typically charged to businesses in the form of merchant discount rate MDR, and via the float that they would make on the money lying unpaid in customer or business accounts. Typically, end users of wallets would be business selling either their physical products or services in stores to end users, for example, Venmo, Square Cash, Google Wallet, etc. Here, the eighth one is asset management. Ever heard of buying stocks or mutual funds without having to pay a commission fee? Fintech companies like Robinhood are enabling investors to trade for free in exchange for their data. They forward this data to high frequency traders who can then influence the price of the asset. Even though the investor might pay a slight higher price for their asset, the difference between the amount they save from trading fees and the slight increases in price is still positive. The ninth one is digital banking. Imagine our traditional brick and mortar banking going completely online. No physical office, no bank tellers, no mail. Challenger banks such as N26 are offering no frills individuals and business bank accounts through a complete digital infrastructure. The business model here is almost identical to that of bank with physical branches, except that with the huge cost savings in manpower and real estate, customers can greatly benefit from reduced rates. And the last one business model is digital insurance. As with digital banks, fintech companies operating in the insurance industry are taking all of the traditional services onto the digital world, offering life and health insurance with better underwriting practices. These fintechs can price their premiums at variable rates depending on the customer, thereby offering aggressively cheaper coverage compared to traditional insurance companies. These types of insurance, together with personalized marketing, can create business possibilities that insurance companies have only begun to explore. Lemonade, for example, is operating in the house insurance space. So these are different types model through which we can deliver our product, and it will be developed in the target markets. So that's it from my side.
I will continue. Financial products are investments and securities that are created to provide buyers and sellers with a long term or short term financial gain. Financial products enable risk to be spent and liquidity to circulate around an economy. Derivatives and options. Many financial products are derived from an existing asset or other financial product, and such products are called derivatives. Derivatives can be placed into one of two categories. First one is forwards, which are contracts to deliver something, usually a financial benefit, at some point in the future. And second is options, which are contracts that give one or both parties to a financial contract the right to gain a certain benefit in the future. The futures are contracts to buy or sell a real or financial commodity at some point in the future, but at a price agreed at the time of exchanging the contract. Bond markets. Corporate bonds are financial securities that are sold by private firms to raise large sums of money. Government bonds, referred to as gilts, are issued by central and local government also to raise large sums. And swaps are derivatives that allow the user to exchange one type of bond or another, commonly a fixed rate bond for a floating rate bond. And hedge funds. Hedge funds are investment funds for wealthy depositors looking to make a secure return by exploiting the skills and expertise of the professional fund manager. Hedge funds, which deal largely in derivatives, have become an important investment option for individuals and investing organizations, including pensions funds and insurance companies. Financial marketing today is mostly using digital marketing activities and tools, including online marketing, web design, and brand development. The customers are already online, so financial businesses need to be online as well. Furthermore, in order to succeed, financial businesses need to be super user friendly. Also, they need to really listen to their clients and offer them the best solutions to their problem. Financial and insurance companies should tailor all their financial products and services to the best user experience. And customers are becoming more and more demanding, forwarding and involved. So personalization as well as great customer nurturing and delighting programs need to be implemented. That's it from my side.